What if I told you that the secret to massive wealth lies not in following the crowd, but rather in defying it? Intriguing, isn't it? Welcome to the world of Warren Buffett and Charlie Munger, two titans of investment. Their philosophy? A contrarian approach that has stood the test of time and market volatility. When the world zigs, they zag. When others are greedy, they are fearful. And when others are fearful, they become greedy. Their strategy is a masterclass in thinking differently. At a Berkshire Hathaway Inc. annual meeting, Buffett, the sage of Omaha himself, revealed a surprising insight into the company's investment strategy. It's not about encouraging others to buy the stocks they already own. Quite the contrary. Their approach is rooted in the wisdom of not hyping the stocks they own. It's about seeing the bigger picture, the long-term value, rather than short-term market trends. Why this contrarian stance, you ask? It's simple. Berkshire Hathaway often continues to buy stock, and as such they stand to gain more from lower stock prices. So, hyping up a stock they intend to buy more of would only serve to drive up its price. That's counterproductive to their long-term strategy. It's a stark contrast to the Wall Street mantra of talking your book, where the aim is often to inflate the value of stocks one owns in the short term. This alternative perspective is shared by Buffett's longtime business partner, Charlie Munger, who once quipped, "Warren, if people weren't so often wrong, we wouldn't be so rich." It's a humorous but pointed commentary on the power and potential of contrarian investing. So there you have it, the secret sauce of Berkshire Hathaway's success. A contrarian approach that prioritizes long-term value over short-term gains, a philosophy that has turned Buffett and Munger into legends in the investment world. In a world driven by short-term gains, it's refreshing to see a different approach. But how did this strategy work out for Buffett and Munger? Stay tuned for the next chapter in their remarkable journey. To understand the effectiveness of this contrarian approach, one must delve into the journey of these two titans of investment. The tale of Warren Buffett and Charlie Munger is one of a shared vision, strategic patience, and a deep understanding of the market's cyclical nature. Their investment journey began in the early 50s when they were just young men, eager to make their mark in the world of finance. Their paths crossed at a dinner party in Omaha, Nebraska, where they discovered a mutual love for Benjamin Graham's value investing philosophy. Buffett, a disciple of Graham, had already started applying these principles, buying undervalued stocks and holding them for long periods. Munger, on the other hand, was a lawyer with an interest in real estate, but saw the potential in Buffett's approach. The two quickly formed a partnership that would last over 6 decades and counting. Their strategy was simple yet powerful: buy and hold. They focused on companies with strong fundamentals, good management, and a competitive advantage, businesses they understood and believed in for the long haul. This approach often put them at odds with Wall Street's short-term, trend-following mentality. Their journey wasn't always smooth sailing, though. In the early 70s, amidst a market downturn, their investments in textile mills began to sour. Instead of panicking and selling, they doubled down, buying a controlling stake in the struggling company. That company? None other than Berkshire Hathaway, which would become their investment vehicle for the decades to come. Buffett once famously quipped, "Our favorite holding period is forever," encapsulating their long-term vision. And Munger, always ready with a witty retort, added, "The big money is not in the buying or the selling, but in the waiting." This patience and unconventional thinking have yielded significant success. Today, their combined net worth is in the hundreds of billions, with Berkshire Hathaway being one of the most valuable companies in the world. But their wealth is not their only legacy. They've also gifted the investment world with invaluable wisdom and a model of integrity. Their annual letters to shareholders, brimming with investment insights and life lessons, are eagerly awaited by investors worldwide. Their commitment to philanthropy, pledging the majority of their wealth to charitable causes, is a testament to their values. In essence, the journey of Buffett and Munger is a story of two men who dared to think differently, who understood the value of time in investing, and who trusted in the power of compounding. They've shown the world that patience, strategic thinking, and a long-term vision can indeed yield extraordinary results. Their journey is a testament to the power of unconventional thinking and patient investing. But what does this mean for the average investor? You might be wondering, how can I apply this wisdom to my own investment strategy? Well, let's take a moment to explore alternative strategies such as fractional investing. This method offers the opportunity to own a slice of an asset rather than the whole pie. For instance, in real estate, fractional investing allows you to invest in a portion of a property without the need for direct ownership. This can be particularly appealing for those looking to dip their toes in the property market without the burden of full ownership, or for those without the means to purchase an entire property outright. The beauty of fractional investing lies in its inherent diversification. By owning a piece of multiple assets, you spread your risk and potentially gain exposure to a variety of markets. This approach aligns perfectly with the philosophy of Berkshire Hathaway, which emphasizes the importance of long-term value. Remember, as we've learned from Buffett and Munger, it's not about short-term market trends, but rather about the enduring value of an investment. But the benefits don't stop at diversification and alignment with long-term value. Fractional investing also provides the opportunity to generate passive income. For example, if you own a fraction of a rental property, you'll receive a portion of the rental income. It's a way to let your money work for you, even while you sleep. In essence, fractional investing offers a method to apply the wisdom of Buffett and Munger in a practical, accessible way. It's about seeking enduring value, diversifying your portfolio, and generating passive income. It's about investing with a long-term vision rather than chasing short-term market trends. So as you contemplate your investment strategy, consider the wisdom of these two titans. Remember their contrarian approach and their focus on long-term value. And most importantly, remember that there are many ways to build wealth. Just as Buffett and Munger have shown, there's more than one way to build wealth. The key is to find the strategy that aligns with your own long-term vision. So, what can we learn from the investment strategies of Buffett and Munger? Well, let's take a moment to gather our thoughts and reflect on the wisdom we've been exploring. It's clear that these two titans of investment are not just focused on making quick bucks. They are in it for the long haul. Their long-term vision and strategic patience have been instrumental in their success. They don't just ride the waves of the market. They make strategic decisions based on thorough analysis and a deep understanding of the companies they invest in. They've shown us that success in investment isn't about jumping on bandwagons or scrambling to buy the latest hot stock. It's about carefully considering your options, doing your due diligence, and making informed decisions. It's about seeing the bigger picture and understanding that the value of a company isn't always reflected in its current stock price. And it's about having the courage and conviction to stick to your guns, even when your approach goes against the grain. One of the key insights we've gleaned from Buffett and Munger is the importance of a contrarian approach. While many investors are swayed by market trends and popular opinion, these two have thrived by going against the tide. They don't invest based on what's popular or trending. They invest based on what they believe has long-term value. This contrarian approach is not about being different for the sake of being different. It's about having the courage to defy conventional wisdom when it doesn't align with your investment strategy. It's about not letting market hype or fear influence your decisions. And it's about understanding that the path to wealth isn't always the one most traveled. And let's not forget their stance on portfolio diversification. They've shown us that investing isn't just about stocks. It can also involve other avenues like fractional investing in real estate, allowing for wealth accumulation through passive income. This aligns with their philosophy of seeking long-term value and diversifying investment portfolios. In essence, the wisdom of Buffett and Munger isn't just about investment strategies, it's about a mindset. It's about understanding that success doesn't come overnight. It comes from patience, from strategic planning, and from a willingness to defy the norm when it's in the best interest of your long-term goals. So, as we wrap up this journey into the world of Warren Buffett and Charlie Munger, let's take these lessons to heart. Let's strive to see beyond the immediate, to make decisions based on careful analysis and long-term vision, and to have the courage to defy the crowd when necessary. Remember, in the world of investment, it's not about following the crowd. It's about carving your own path, just like Buffett and Munger.